I don't know about you folks, but this is one of those episodes I look forward to each week. We get to look at what happened in the stock market last week. We get to talk about key economic events next week and how the market might be set up for. And again, this is an area I am not good at, so I rely on experts. And we have the one and only Dan Bird from Breakpoint Trading. How you doing, young man?
I'm doing well. How are you?
I'm doing well. I don't say this enough. I just want to thank you for giving us an hour each week. Hopefully, you see the comments. People thoroughly enjoy you being a
Good.
part of the channel, and I appreciate it as well. So, thank you very much.
Well, that's good. I appreciate it. As you know, I do this for myself primarily, and I'm more than happy to share. I have some folks that actually have emailed me, and I've helped them out, or at least given my opinion. I don't make recommendations on what to buy and what not to buy. That's, everyone has their different risk profile. But I'm happy to help people out. Um, and if at any point you think there's not enough interest out there, we could
Yeah,
just end it. So that's
dude.
fine.
Yeah, you
I'm
and
gonna
I have known each other for well over a decade. So yeah, there's
right.
no secrets.
Yeah. I mean, I'm gonna do it for myself anyway. So I'm still
Yeah.
gonna send the newsletter. It doesn't matter what else. So. Hey, by the way, just as a side note, um, remember last year we talked about my becoming a reluctant landlord,
I do remember.
and the real estate market has been interesting over the last
Sure.
year.
Yeah.
So just an update on the property that I was basically forced to buy
Sure.
for my kids to keep them from moving in with me.
Yeah, I'd
um,
make that trade too.
yeah, exactly. So I bought basically at the peak or almost the peak of the market
Yeah,
last March at a point where houses were coming on the market and selling the same day.
I remember.
And I was having to go out and look at houses and put an offer in, and they would have 20 offers, and the next day they would choose one of them.
Right.
And then I'd go out the day after that on a whole new set that just came on the market that morning, and there'd be 15 offers on those.
Uh,
That's what the market looked like a year ago
okay.
that I had to buy into. So I ended up buying one for 318.
Okay.
Um, I don't know if you want me to actually share it. I could share it if you want to see it.
Well, Ed, whatever you feel comfortable sharing. So it's fine by me.
Actually, maybe I won't.
Yeah.
I don't want.
Yeah.
I don't
You don't
want
want to
my.
give people your address. Yeah, I
Yeah,
wouldn't.
exactly. I don't want my kids. I'm not there, but they are.
Yeah. 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 People you care about are there. So that's okay. So
Right.
you bought it for 318.
So anyway, I bought it for 318, um, which was essentially 4,000 over asking.
Okay.
Um, and it went up to 355
Wow.
in the
Okay.
first 3 or 4 months, roughly.
Yeah, it was crazy. I remember. Yep.
Yeah. And then it came down. I think the lowest that I got to was 315.
Okay.
And right now it's at 321.
That's pretty common for a lot of the country, right? There was this peak buying in March, April, May. We got really cold October, November, December. It really changed really January 15th for whatever reason. I have a lot
Yeah.
of people who are flippers in my network, and many of them were telling me, hey, I've got property that are 60, 75 days aged. And then all of a sudden they're like, oh, all my inventory's gone. So
Right.
it does seem like, the demand is coming back because there's
There
no
aren't, yeah,
supply.
there aren't nearly as many on the market right now as
Yeah,
there,
there's
as there
nothing.
were.
There's no supply.
Right. And they're sitting for longer. So, but I think the positive thing is that, and this is kind of what we talked about a year ago too, was that it wasn't going to really crash necessarily, it just wasn't going to keep going up.
No, I
So,
totally agree. That's been my call for a year. Yep.
right. So I mean, that kind of proves it. It's kind of stabilized right now. It really hasn't moved off of that 320 to 325 area for the last 6 months, probably.
Yeah, and again, that's kind of what housing should do. Housing
Right.
shouldn't move 20%. That's
Yeah,
not
that's right. It
normal.
shouldn't it shouldn't move up 20%. You should just pay down your mortgage every
Yeah,
year,
yeah. Yeah, you get
right?
inflation plus, 0.5% or something. Yeah.
Yeah.
I did a
And so
52-year spreadsheet. I mean, if you go back and look at it, which again I give away for free, housing's up about I think it was 1.1% above inflation.
yeah.
Yeah. 20% is
Yeah.
not normal.
Right, right. I mean, if you get renters paying off your mortgage, then you're
Why not? Cash flow
building
positive.
value. You're building value if it doesn't do anything.
Yeah. One rental at a time works. Fixed rate debt, cash flow day one, hold to maturity. Good to
Yeah.
go.
As long as my son can keep his job.
There you go. There you go. Well, hey, let's talk about the market.
Actually, if he had to move, if I had to kick him out,
Yeah.
of course he'd have to move. He'd move in with me, but if I had to kick him out, I could actually get more rent.
Of course. Of course. Yeah, the downside's too great. You'd pay that mortgage. Let's just be honest.
Right.
He's not moving in with you.
Exactly.
Well, let's talk about the market. How's it set up? We got a monster CPI reading on Wednesday. I think we talked about it before.
That is the most important thing, and I haven't really heard many people talking about it, frankly. You know, on CNBC or last week they were talking about everything but next week's CPI.
Yeah, I saw that too. It's weird.
But I think next week's CPI is the most important thing. It is going to, and we'll talk about that because it's really important. But let me start with a couple of charts, and I'll share here. We'll just take a look at what happened, and we'll look at the standard charts every week. What did the VIX do? The VIX spiked. VIX spiked.
Now, do you think that was more regional banks being shorted, or
a lot of things happened last week? Regional banks was part of it. One more went under, and a couple more, are on the brink probably. Yep. Wouldn't be surprised if we get a couple more going under. Yep. Earnings have actually been pretty good overall. I think better than a lot of people expected they were going to be.
Sure.
But some companies missed as well. So, I mean, Amazon didn't look that great.
Right.
Looked okay, but not that great. So I think it was a combination of things. And then, actually, let me show my newsletter real quick because there's something there we can talk about too. So if anyone's interested in getting my newsletter every week, it's free. I don't sell emails. I don't, share your emails with anyone. It's really for my own personal use. It's the reason I created this for my friends and family. But if you're interested, just send me an email to breakpointtrading@gmail.com, and I'll add you to the list. And this is really what I wanted to talk about here.
Right.
So last week's numbers, if you look at the non-farm payrolls.
Yeah.
Interestingly, so let's go further back in the week. Let's go to Wednesday, because this is the reason that I think the market went down. The FOMC statement, so the Fed statement, was a little bit more hawkish than expected, even though he said that, or the market interpreted that he was saying that they might be pausing. He didn't actually say that.
Correct.
But they changed the wording a little bit, saying that they'll look at the data and make a decision based on that. They did get a 1/4 point increase, just as we expected. And I think the market, the statements were a little bit hawkish, so I think that sent the market down after the meeting. But the payroll number on Friday came in really strong.
It did.
Much stronger than expected.
Yeah, it was kind of a triple beat, right? Payrolls came in stronger, unemployment rate came in lower, and wages were higher. I mean, it was kind of a triple beat, triple bad.
That's right. Payroll, unemployment in general is really strong. You can't have a recession with 3.4% inflation.
No, you can't. No.
That's the lowest that's a historical low.
Yeah.
I mean, you go back, I'm not sure there's even a lower one than that.
Yeah, I've looked it up. There was something, I think in the late 50s, 2.6, I think was the lowest on record, I think.
Yeah. Okay. So, it's a 40-year, more than 40. It's
70-year.
70-year low, 3.4%. You can't have a recession with that kind of employment. Now, employment is always a lagging indicator. It's the last one to fall, but still. I've said many times on this channel, the recession will not happen until this starts to increase materially.
When you say materially, let's put a number on that.
I mean above 4%.
Yeah, I agree. Yeah.
So, and when that happens, we might be 3 months away from recession.
Okay.
The other one is the inverted yield curve, which I've talked about. That's still inverted. Recession doesn't happen until 6 months after it goes back above zero. So we are probably beginning of next year before a recession is here.
Wow.
But look at what we have for next week.
I can't believe that number.
Yeah. So
5%.
the interesting thing about this is earlier in the week, I looked at this every day. And earlier in the week, this was actually at 5.2%.
Oh, interesting.
It was actually predicting it to go higher. And I think it is going to go higher.
Oh, so do I. I said that a month ago.
And I think it might be much higher than even 5.2.
Ooh, interesting.
Now look at PPI. PPI is predicted to go higher as well. So that's really important. So both of those things together. We'll take the non-farm payrolls. I think the market liked it because the market is already thinking that the Fed is going to pause. So good employment numbers is good for the market. So the market started going back up on Friday. But even with that big rally on Friday, we still didn't break out of the channel that we're in.
No, it's been in that channel for a long time.
Yes, quite a long time.
Yeah, let me talk about CPI for a minute. I don't know if you know this, but I've actually on my channel on my daily financial news, I said the whatever it was, the May 3rd Fed meeting was horrible timing because we didn't get a lot of the economic data from SVB yet. The next Fed meeting, which I think is June 14th, is actually really good timing because again, I think both you and I fear this CPI will be hot.
Yep.
But I actually think the next one will be in the fours because the base effect and what's happened to commodities.
Okay. Yeah. So I have a chart for that.
Oh, look at you.
So these are the two that this one and the next one are the reasons why I think that the number is going to be much higher next week. And I think the market is premature in its rally.
Oh, I agree. So I like putting numbers on things. When you say much higher, I've guessed 5.253.
I think it could be 5.5.
Whoosh.
It's going to be interesting because it will depend on the next chart I'll show you here in a second, but it's going to help me understand where the numbers are coming from. And I'll explain that in a second. But first thing is the base effect that you just mentioned. So the last one last month, look at this big increase that dropped off last month. Right there. So last month, the prediction was 5.5 and it went to 5.
Yep.
A full point. And a lot of that was because of this base effect. Mm-hmm. Some of it is what I'm going to show you in the next chart. But look at what happens the next week. Nothing. Very little one. It's a very small one that's dropping off. So that's going to probably push it back to 5.5. The expectation for last month is what we're going to end up getting this month. Mm-hmm. All right. So that's one of the reasons right there. Now look what happens after that, though.
Yeah. We get two monsters. Yeah.
The next 2 months are huge. I mean, after we get the one next week, which is going to be worse than expected, and probably will send the market down. We'll see how the market reacts. You can't predict what the market's going to do. You know, a lot of times people buy on the news and sell, or buy on the rumor and sell on the news. You just don't know. So it's more important not so much to anticipate what the market's going to do, but to see what the actual reaction is. So we'll see next week what it is. The market may also be looking at these next two saying, yeah, oh yeah, so what? Yeah, it went up. We kind of expected that. Great. We're just going to keep going higher. But I think it's going to probably go lower because of a combination of this and the next one I'm going to show and the employment report being so strong.
Okay.
A combination of all of those things is going to, I think, force the Fed to add another quarter point in June.
Yeah, see, I would normally agree with you, except again, I think we're very lucky this time that we get a second CPI print pre-Fed meeting. And I think the next one, because of what you're showing here,
yeah, that's true.
Force.
That's true. Yeah. So the next one is this chart that I've been tracking
Yeah,
all
I
along.
love that you do this. Yes.
So now you can see all of the increases, so a little more than a year ago, we started at 0.08 and now we're at 5.08 in roughly 14 months. A lot of things you can point out on this chart. The first one, and the other reason I think that we might get a bad number next week, is look at what happened mid-month. So this shaded area is what the next report is going to encompass.
Mm-hmm.
And I think, although I haven't been able to confirm this, but I think oil and gas is calculated from the middle of the month, not from the full month.
Yeah, I think so too.
And you can see here in the middle of last month, it hit its low, which is one of the reasons it dropped a whole full point rather than just a half point it was predicted to drop. Oil and gas dropped to its lowest point in the middle of last month. Okay. Now this time, even though all of these have been coming down pretty dramatically, actually, but they hit their peak in the middle of the month. So if you look at that in combination with the basing effect, I think we're going to get a much worse CPI number next week than the market expects.
Wow, you're right. I mean, just looking at where we were mid-month to mid-month, I mean, you're right. It could be, it might be a 5.5. Oh,
right.
That would be bad.
Right.
That would be bad.
But it's only going to be temporary.
I agree. I think that's why I think we're so lucky that the next CPI print comes a day before the Fed meeting.
Yeah, the next two are huge. The next two after this one are huge because they're going to drop. I mean, we could be back to 4% by July.
Yeah, we could be certainly low fours. Certainly.
Right. Now, to be clear, when we say that, here's peak inflation over here, when we've dropped down to 4%, everyone is kind of being conditioned to think that dropping to 4% is great, but it's still 4%.
It's still double the target.
It's still double the target, right?
Yeah.
So it's not like inflation is going down. That would be deflation.
Right.
It's just that it's not increasing as fast as it used to, or as fast as it
Disinflation.
was earlier.
Mm-hmm.
But it's still high.
Yeah.
So we'll see what happens. I mean, this next one, the next CPI, if it does come in at 5.5, it will confirm for me, at least, that gas and oil is calculated from the middle of the month.
Right. That'd be good.
Because you can see where I've drawn the arrows. Gas actually went down through the whole month, the full month. Oil went up slightly, but not by much for the full month. But it's this middle of the month peak right here.
Just bad timing. Yep.
That's what I'm wondering about.
Yeah, we'll know on Wednesday morning.
Yeah, the other thing that jumps out at me on this chart, as we're talking about the market, is that we've got 1, 2, 3, 4 3/4 point increases right here.
Yep.
You see those?
I do.
Now, if you follow that up, here's the first one.
Okay.
Right? This is in the low of June. And then the last one was here. The market was basically at exactly the same place after 4 3/4 point increases. You see that?
I do. Yeah.
And since then, with another, 1 1/4 added on, the market's higher.
Yeah. So we're up, 15% roughly?
Well, from 3,700 to 4,100.
Yeah. So 10% anyway, 10, 11%.
Right.
Okay.
But the point is the market has already priced all of this in.
Yeah, the market absorbs early.
Now I think it could have a temporary retracement if we do get a 5.5 print next week. It might even give those that are trading an opportunity to get in again lower.
Good. Yep.
We'll see. we'll see what happens. Again, it depends. The market might be looking past even that. Although I don't think it's expecting another quarter point hike. So we'll
No,
see.
the current betting, I haven't looked this morning. For next meeting, 98% pause, 2% cut, 50% chance of a cut by September. Nobody that I know of is calling for a June rate increase.
That's not going to happen. I mean, just based on what I said earlier, that
I agree.
The recession won't be until next year. It's not until, the recession is imminent that the Fed's going to start cutting. And with employment numbers like we just had, the Fed's not going to cut with that kind of employment.
I totally agree.
It's not going to happen.
Nope.
So here's the range that we've been in. Right here. Even with that nice rally, the rally the last week or the week before, and then last week's rally, it still hasn't broken out of this range. Basically 4,200. You can't get through 4,200. I'll show you. There's a very long-term chart, and you can see, these are the same lines right here.
Yep.
Between 3,800 and 4,200. That's where we're stuck. And we're also in an upward sloping channel as well. So until it breaks through 4,200, the market might just continue going sideways, just like it is. We'll see. I mean, I think there's this rally on Friday is going to probably carry through on Monday. Mondays in general are always the worst day of the week.
Oh, interesting. Okay.
But I think it's going to still carry through. And then we've got Tuesday, and then Wednesday morning is the CPI. So
yeah,
we might get close to 4,200, and then that does come in much worse than expected. It might push us right down again.
Yeah, you've actually changed my opinion. I think 5.2, my kind of 5.2, 5.3 call might be low.
Right.
And,
yeah, especially when it was already forecasting 5.2 earlier last week, which I thought was interesting that it then went back to 5.
Yeah, that is odd. Yeah. Okay.
So we'll see.
There you go.
What else we got here? That's just the general market. You can see the range that we've been stuck in for quite a while. This is the long-term chart, and I said this a few weeks ago, that this shaded area is traffic jam.
Yep, I remember.
We're going to get into that area, and we're going to be stuck there for a while. And that's kind of what's been happening. 4,200 is a Fibonacci level. Mm-hmm. And then 4,300 is a quadrant line. This is the quadrant between the low, actually, let me bring this out a little bit. From the COVID low, right back here, to the high of 2021. These blue lines divide that period into 4 equal quadrants. And the market is very symmetrical. Many times, it's not always, but many times it's very symmetrical. So if you break this into quadrants, you can see this 75% quadrant is right where we are right now. Exactly where we are right now. Almost to the penny. All right. If we get through that, then we're in the upper quadrant of this period, going back to 2020. Now, if we divide it, if you look at these gray vertical lines, these are equal distant in time. Again, it's very symmetrical. You can see how the market goes down, it comes back up. It goes down, it comes back up. So it's been acting very similar across this period right here. Basically just stuck in a channel, essentially.
Yeah, just stuck in a channel. That's what I think about every day when I look at the closing price. I'm like, oh, still in the channel.
Yeah. Now there's some ways you can make money doing that with options. You do an iron butterfly. I won't get into that today, but do an iron butterfly where you make money if it just stays where it is, doesn't move anywhere. So there are ways to make money in sideways markets too. This is the secular bull market that I've always talked about.
Yep.
This one goes back to 1990. And I listened to one of your videos with I think your stock guy. What's his name?
Taylor from Life Goal Investments.
That doesn't sound familiar.
Okay.
There's a guy that was, it might have been him, but he was talking about that, 2000, 2001, the market went down and kept going down. And people that didn't know what they were doing lost all their money and never went back. And you raised your hand. So that was me.
Yeah, that was me.
Yeah. Of course, in the middle of that period was 9/11.
It was.
So that kind of exacerbated it. But even before that, interestingly, because I looked at this in the context of 9/11, you see this, see that one big long red one right there?
I do.
That's 9/11.
Yeah, that was the first trading day post 9/11. Yep.
Yeah, this is actually a month. This is a monthly chart.
Oh, month. Okay, got it.
So that would be the month of September.
Got it.
Right there. But interestingly, this indicated a secular bear market well before 9/11 happened. It was after the peak, of course, but it indicated a secular bear had started when it goes below this 200-week moving average, this red line right here. All right, and that happened well before 9/11. Happened around April. And these other ones up here that I watch to see if we're still in a secular bull market, which we are, these went into a secular bear at these points as well. All right, so even though 9/11 happened right in the middle of that downtrend right there, we were actually already in a secular bear market.
Yep.
Now, we came out of that, technically, we came out of it once we exceeded the high. So these highs right here from 2000 and then 2007, 2008, or 2007. Even though we had this big, huge rally from 03 to 08, we never broke out higher than that 2000 high. So that still maintained a secular bear. All right, until 2013. 2013 is when we actually broke out of that secular bear. Now, you could mark it from 2009, which was the low, but you don't really know because we could have come up here in 2013 and gone right back down again.
Right.
So technically, from a technician standpoint, it technically hasn't broken out of the secular bear until 2013. Now, secular bulls typically last, this one was 81 to 2001, 20 years. It typically lasts 18 to 20 years. So this one has till 2029 to 2033. I am predicting that 2029 is going to, all hell is going to break loose in 2029. It's 100 years since the 1929 market crash.
Yeah. Mm-hmm.
And everything else in our economy is lining up. I'll show you something here in a second. Is lining up to have everything start crashing in 29. But we're not there yet. We're not at that point yet.
Okay.
But the secular bull that we're in, it has not closed below this 200-week moving average, this red line. Okay. All right, so one of these things needs to close below it in order for me to say that we are no longer in a secular bull. Mm-hmm. And usually it's going below this 200-day, closing below this 200 days, usually the first sign. But it could be any one of these three. None of them have gone below it yet. So if that's true, if we are still in a secular bull, it should take us back to the highs at 4,800. I don't know when it will get there, but it should take us back up here. Now, after we get our CPI print next week, if it is worse than expected and we get a retracement, which I think we will, or a correction. And by the way, I think that same guy was talking about the definition of a correction, a bear market, and a crash. Mm-hmm. That's the one I watched.
Yeah, it's Taylor. Yeah.
Right. So I like to think of a correction as just exactly the meaning of that word. The market is correcting back to normal. It's correcting. Okay. It's not a bad thing. It's what the market's supposed to do. It's supposed to correct back to normal. So that's what I think we've done here. Look at this huge run up right there.
Yeah.
So that's what I think we've done here. And that, yes, that is technically a bear market as well
Sure.
because of the amount that it's gone down. But I think we're going to slowly start coming back up. Now, if we do get a retracement next week, then I think it's an opportunity because just like we said, we're going to have, it's going to look like inflation is dropping off a cliff after that one.
Yeah, for 2 months for sure. Yep.
And the market will just keep going higher. Now, in the second session today, we'll look at some stocks that reported earnings last week. But this is CPI. We looked at that. We looked at that. Here's non-farm payrolls. I put this together just out of curiosity. Mm-hmm. So non-farm payrolls is this blue line right here. PCE, which is what the Fed looks at. Price consumption. I don't remember what the E stands for. But at any rate, that's what people actually are spending their money on.
Wow.
The CPI, this is headline CPI, the purple one down here, the pink one.
Yep. Yep.
Headline CPI is what the cost of goods is, what the price is, as the rate of change of the price, the cost of goods. PCE is what people actually will take their hard-earned dollars and spend their money on. And I thought it was interesting how closely that maps to non-farm payrolls. Much closer than headline CPI does.
Yep.
And then here's the Fed rate hike right here. And all of these are kind of meeting in one place right now.
Wow.
Here's the non-farm payroll rate of change over 12 months. You can see, even though we've been getting strong payroll numbers, they've been slowly coming down.
Yep.
Which is what the Fed wants to see as well.
For sure.
So even if they get a strong one, I mean, the past 3 months were revised significantly downwards.
Yep.
So even with a strong payroll number, that doesn't mean it's going to stay there. It's still trending lower, although at a very slow pace. So that's good. That's good for the economy.
Yeah, I mean, so far the soft landing can't be taken off the table.
That's right. Exactly. And then we'll look at the US dollar hitting lows again after this little rally in February. Dollar's back down hitting lows. You can see how the green one is the dollar and the gold one down here is gold. So I said this a while ago too, that gold was going to keep going up. I think gold will probably retrace back to this level down here.
Yeah, it had a good week last week.
Yep. Had a good week last week, and I think it may still come down a little bit before it takes off. It could take off with the CPI number, actually.
Yeah, that could be. Yeah, it could. I agree. Yeah, so inflation's raising its head. Gold could be a natural.
Yeah. I think gold is going to take it up to new highs, and then
now. So let me just ask this question: have you put any of your money in gold recently?
Interestingly, I did make a play, and we'll see how it works out based on this.
What does that mean?
Bought a long-term. Okay. I bought a long-term call.
Oh, okay.
Very cheap call.
Your strike was what, 2,500?
Strike was 2,200.
Oh, 2,200. Okay.
Or in August expiration.
Oh, all right. So 3 months. Okay.
Yeah. 3 months. If it doesn't, I'm only going to lose $750. But if it does, I'm going to make $20,000.
Wow. So you bought 2,200. Oh, that seems like a great trade.
Right.
Okay. All right.
1,000 shares, basically.
Yeah, you bought 10 contracts. Yeah.
10 contracts cost me $750.
Now, will you hold those till termination, or?
Oh, no. I don't want to hold them till termination. And the reason why is this.
Oh, yeah. This. Okay, got it.
That's a time decay on options.
So you'll be out. You'll be out in July sometime.
I'll be it's August. I'll be out sometime, probably beginning of July. You can see right here 30 days where it really starts dropping off a cliff, and actually 45 or 60 days where it really starts to accelerate to the downside.
Okay.
So I want it to go up to 2,200 would be nice. 2,300 by June, July. We'll see. By July, beginning of July. We'll see.
There you go.
But it's a low risk trade. So, by the way, here's the interesting one that I was going to show you. That comes from Ray Dalio. I don't know if you've seen this.
This one I haven't seen. No.
This is a very long term. This is the changing world order. This is basically what he thinks the steps that an economy or a country or an empire or what have you goes through. You know, strong leadership, inventive education, strong culture, good resource allocation, competitiveness, strong income growth, strong markets. We've been through all that. Less productive, overextended, losing competitiveness, wealth gaps, large debts, which is where we are now, and printing money, which I think this is right where we're at, which I think he says too in the article.
He does.
He thinks we're right here at number 14. And then that moves to internal conflict, loss of reserve currency, weak leadership, civil war, revolution. I think we're going to be at loss of reserve currency by 2029.
Oh, okay. 2029. All right. Do you have a prediction on what's going to replace it, or
I don't know yet, but the BRICS, what the BRICS are doing is should be cause for concern.
Okay.
You know about those, what they're doing?
Yeah, Brazil, Russia, India,
China,
South Africa, I think.
Right. Yeah.
Yep.
Yeah, I think they could put together something, and especially if we keep spending money like we're spending.
Oh yeah. And
raising the debt limit. We have to raise the debt limit. So there's no question about that. But we don't even have to lose our status as a reserve currency in order for the dominoes to start falling.
Sure.
We just have to have somebody create an alternate reserve currency. So if there were two reserve currencies, that would be enough to topple us over.
Define topple over? You mean the stock market?
Well, think about it. The reserve currency means that's the base that's used around the world.
Sure.
For instance, when countries buy oil, they buy it in dollars.
The petrodollar, yep.
Because that's the reserve currency. So if they have an alternative to that, and what that means is in order for them to be able to do that, they buy our debt.
Yeah.
So they buy our bonds in order to have the dollars as a reserve currency, because it's the reserve currency, in order to buy oil and other things. Mm-hmm. All right. So if there is an alternative to that, what that means is they will use some other reserve currency in addition to ours to buy things like oil. But that means they don't have to buy as many bonds from us as they used to. Yep. Not only do they not have to buy as many, they could actually start selling some.
Yeah, diversify. Yep.
That by itself will have a huge effect.
Stuff to think about. So we've got 5 years to try to get our house in order. This is certainly reasons to be concerned. Yep.
I just keep an eye on that. I said this probably 7 years ago when I first started doing little informal meetings in my community 7 years ago. And I introduced this idea to everybody that the United States as a reserve currency, and explain what that means to be a reserve currency. And I said at the time, it wouldn't take much to topple our economy. Not just to take away our reserve currency status, because there really wasn't anything to replace it. Certainly wasn't 7 years ago.
Yeah, 7 years ago, yeah.
I said, but watch what happens in the world if someone comes up with an alternative. It doesn't have to replace our reserve currency. It just has to be an alternative so that countries no longer have to buy our bonds, or as many of our bonds.
Right.
With the way that we keep increasing our debt and raising our deficits, we're doing that because we have a reserve currency. And because we expect countries around the world to continue to buy our dollars and buy our bonds, and bonds is debt. That's what bonds are. It's debt. So we expect for countries around the world to buy our debt. That's why they keep running up the deficit. But if they keep doing that and countries no longer have to buy as much of our debt any longer, that will topple our economy.
Oh, fun stuff to think about. Fun stuff.
2029, 100 years since the Great Depression.
Well, hopefully you and I will still be doing our shows together by then. So we'll do our best to keep people informed. Show your newsletter real quick.
Yeah, so breakpointtrading@gmail.com. If you want to get on it, I'll send you last week's and put you on. If you want to be taken off, just let me know. It's not a big deal. By the way, this is the debt crisis. I put this chart in the newsletter.
Oh, thanks.
Here's a bigger one right here. This is from Stock Traders Almanac. So
2011.
2011 was the last debt crisis that we had. Very similar. We had a Republican Congress and we had a Democrat president.
Yep.
And they were playing chicken with each other all the way to the end. Now, we can't not raise the debt ceiling.
Yeah, I agree.
That would just be stupid if we didn't do that. But they will continue to negotiate right up to the end. So what happened last time in 2011, you notice here in July, actually in June, IMF says U.S. must lift debt limit to avoid severe shock. Republicans declare an impasse. In July, Moody's puts U.S. on review. S&P threatens to cut U.S. credit rating. Talks break off in Congress. In August, budget was finally passed, but S&P cut the U.S. credit rating anyway. All right, that's the kind of thing that will encourage other countries to create a new reserve currency.
I agree.
That type of action right there. If we do not raise the debt ceiling, it will have significant consequences for us.
I agree.
As a matter of fact, let me show you. Let me bring this up. Here's the other cartoon I put. It's going to be hilarious to watch the Democrats blow up the debt ceiling.
Everybody's in it together.
We're all attached to the same bomb, people.
Yep.
It's not for politics. So it has to be raised. There's no question it will be raised, but what's going to happen between then? Now, interestingly, in 2011, see how closely we're mapping to the market in 2011?
Yeah.
Almost identical.
Pretty wild.
We are here. If we get a bad CPI number next week,
yeah,
there's the correction.
Yep.
Into June. Now, I don't know if that's going to happen. Doesn't mean it will happen. But I would say that, I'm being careful with what I do. I'm keeping my stops tight. We'll look at some stocks in this next session.
Cool.
But if this does happen, then I think there's a buying opportunity in the next few months until we get to the October timeframe when the market usually takes off. There's a buying opportunity because from there on out, I think we are headed back to the highs. I think we're headed back here. I think we'll eventually break out, maybe in October, sometime in that time frame, break out of 4,300, and then it's off to the races.
Well, we will come back every week to take a look at this. Dan, thank you so much.
You bet.